Amid the government shutdown, President Donald Trump has ordered for mass federal layoffs.
In a dramatic escalation of the ongoing government shutdown, the White House announced mass federal layoffs, confirming Donald Trump's earlier warning that his administration would take drastic steps to pressure Democrats into ending the impasse. As the shutdown stretches into its 10th day, public services across the nation remain paralyzed, and the effects are beginning to ripple through the U.S. economy and housing market. Budget Director Russ Vought confirmed that the administration has begun implementing its plan to dismiss portions of the 750,000 federal employees who have been on unpaid leave. The Office of Management and Budget described the layoffs as substantial, though it provided no details on which departments would be hardest hit. Economists, including analysts at America's credit unions, are now warning that large-scale federal layoffs could send shockwaves through the broader economy. With roughly 3 million people employed by the federal government, about 2% of the total U.S. workforce, cuts of 20% to 25% could affect as many as 750,000 workers. Experts caution that such a reduction could weaken housing demand, lower home prices, and increase foreclosures, especially in regions with heavy concentrations of government employees. Still, not all economists foresee a total collapse. Senior economist Dawit Kabedi of America's credit unions noted that dual-income households and reemployment opportunities may cushion the blow. However, with a national housing shortage estimated at nearly 2 million homes and mortgage rates still near record highs, the potential for localized disruptions remains significant. Yet, warning signs are flashing across America. Foreclosures are rising at their fastest pace in over a decade, with nearly 1 million homeowners behind on their mortgage payments. Credit card delinquencies have surged to levels not seen since the 2008 financial crisis. Layoffs in technology and manufacturing are compounding the pressure, threatening to turn a controlled slowdown into a full-blown economic crisis. This isn't just a warning anymore, it's the beginning of what some are calling America's next housing disaster. Florida's housing market has become the nation's pressure valve, and now it's beginning to burst. One foreclosure now strikes every 267 homes statewide, the highest rate anywhere in America. This isn't about reckless borrowers. It's a systemic housing failure fueled by runaway costs and policy chaos. Home insurance premiums in Florida have skyrocketed an alarming 25% annually since 2020, pushing average yearly costs above $6,000, triple the national median. 7 major insurers have pulled out entirely, leaving remaining carriers to shift risk onto homeowners, already burdened by property taxes that have climbed 30% to 50% in some counties since 2019. Combined with special condo assessments after the Surfside collapse, ranging from $10,000 to $80,000 per unit, Florida's once booming real estate market now resembles a graveyard. The data is relentless. Orlando records 1 foreclosure for every 234 homes, Jacksonville 1 for every 241, and Miami 1 for every 247. In a state long driven by migration and vacation investors, these numbers mark a shift from growth to liquidation. Home values in several coastal zip codes have stagnated since early 2024, while insurance and maintenance costs outpace wages and rents. The average homeowner who bought in 2021 with a 3% mortgage now faces an effective payment increase of 40% once taxes and insurance are factored in. Even without job losses, that equation is unsustainable for tens of thousands of families. Florida's unraveling isn't isolated. It's the leading edge of a nationwide housing correction where cost inflation is outpacing income growth by 5-fold. The state shows how an economy can appear strong on paper while its foundation silently decays. Tourism revenue disguises household stress, and population gains hide financial instability. Beneath the headlines, Florida's numbers mirror conditions spreading across the country: rising insurance premiums, soaring municipal taxes, and stagnant incomes squeezing middle-class mortgage holders. The illusion of a sunshine market has fooled analysts into believing foreclosures remain contained. Yet delinquency pipelines in major metros have expanded for 8 straight quarters. Banks won't admit it, but non-performing loan ratios have already doubled since 2023. This is how a real estate crisis begins. not with a sudden price crash, but with invisible financial erosion. Florida homeowners are running out of cash before they run out of equity. Once that line is crossed, defaults become inevitable. Every key metric, from insurance loss ratios to tax arrears, points in one direction: systemic failure spreading north. The next wave of financial strain is emerging from states once seen as stable, now showing structural economic breakdowns. Alaska, Delaware, and Nevada have become frontline indicators of a nationwide foreclosure surge that can no longer be dismissed as isolated volatility. The data is severe and accelerating beyond the national baseline. Alaska's foreclosure filings jumped 55% year-over-year, Delaware's rose 49%, and Nevada recorded a 43% spike during the same period. These aren't just statistics. They're early warning signs of an expanding credit crisis rippling across America's economic core. Alaska's numbers are especially revealing, as the state's dependence on the energy sector magnifies every downturn and exposes deeper vulnerabilities within the U.S. housing market. Oil production in the United States has dropped nearly 11% since early 2024, while exploration and transport costs have surged by double digits due to persistent inflation and weakening global demand. This imbalance is eroding Alaska's state revenues and employment base simultaneously, pushing mortgage delinquencies up 38% in just 6 months. Median household income has stalled below inflation-adjusted levels, meaning more Alaskans are defaulting not because they bought expensive homes, but because their earnings have collapsed faster than their costs. Delaware tells a different, but equally alarming story. Despite being the nation's corporate registration hub, it now faces what economists call phantom stability. Major financial and legal firms headquartered there rely heavily on external markets for revenue, and as East Coast layoffs intensify, Delaware's real estate market is absorbing the shock. The state's foreclosure initiation rate has reached its highest point since 2013. Property taxes have climbed 22% since 2020, while rising homeowners' insurance premiums have crushed middle-income households. Even with one of the smallest populations in the country, Delaware's mortgage delinquency growth now exceeds that of states 10 times its size, a stark warning that scale offers no protection from a systemic fragility. Nevada, once the poster child of speculative recovery, is flashing red again. Las Vegas housing listings have jumped 34% year-over-year, with inventory expanding twice as fast as buyer demand. Household debt-to-income ratios have surpassed pre-2008 levels, and the casino and hospitality sectors have posted 3 consecutive quarters of revenue decline, undermining wage stability for hundreds of thousands of hourly workers. With mortgage rates hovering near 6.4%, payment-to-income pressures have reached unsustainable levels. These 3 states are not anomalies, they are precursors. A new and deeply concerning source of financial stress is emerging from America's white-collar employment sector. The technology industry, once viewed as recession-proof, has now become the largest generator of new mortgage delinquencies. Between January and September 2025, massive layoffs swept through the industry. Intel cut 24,000 jobs, Microsoft 15,000, Amazon 14,000, and Meta 3,600. These losses directly affect high-income homeowners carrying monthly mortgage obligations of $3,200 to $5,800 on properties purchased during the low-rate boom of 2020 to 2021. Federal Reserve data reveals that mortgage delinquencies among borrowers earning over $150,000 per year have surged 42% year-over-year. In California's Santa Clara County alone, more than 9,000 homeowners entered early default in Q2 2025, the highest level since 2011, while Washington State's King County recorded a 37% jump in 90-day delinquencies. These trends confirm a direct link between high-income job loss and mortgage instability. When 6-figure salaries vanish, financial reserves deplete quickly because fixed expenses, mortgages, car payments, insurance, and tuition consume about 67% of total income. Another major shift lies in the collapse of equity-based compensation. Stock options and bonuses, once used to secure jumbo mortgages, have plunged in value as the Nasdaq has fallen nearly 19% year-to-date. As share prices slide, the collateral backing home equity loans disappears, blocking refinancing and trapping owners in 6.4% mortgages even as incomes fall. Internal banking data now shows that 58% of jumbo loan borrowers are classified as payment-stressed, compared to less than 20% before the layoff wave began. The national impact is immediate. High-income foreclosures now make up 11% of total filings, up from just 4% in 2022. Unlike the subprime borrowers of 2008, these defaults are concentrated among households with heavy leverage, dual mortgages, private school tuition, and annual property taxes exceeding $18,000 in counties like Santa Clara, Travis, and King. Once savings and vested equity evaporate, the slide into foreclosure is faster than in any previous cycle. And this crisis isn't confined to tech hubs. Ripple effects are spreading through adjacent industries, marketing, consulting, and commercial construction, where an additional 95,000 jobs have been quietly lost in 2025. As upper-income earners default, consumer spending contracts and local housing demand weakens across entire metro areas, signaling the next phase of America's unfolding housing market correction. This marks the next phase of economic stress, an affordability crisis not driven by soaring prices, but by evaporating liquidity and collapsing credit confidence. The following chapter examines this transformation, where household debt, inflation, and stagnant wages merge into a single unsustainable equation now defining the American economy. The collapse of high-income job stability has bled directly into the consumer credit system, exposing just how fragile the broader U.S. economy truly is. As mortgage delinquencies spread through professional sectors, total household debt has reached levels no income tier can sustain. By Q3 2025, U.S. household debt exceeded $18.2 trillion, the largest quarterly increase since records began. Mortgage balances alone reached $12.4 trillion, but the real strain lies in revolving credit. Credit card debt has surged to $1.25 trillion, and for the first time since 2008, over 7.3% of balances are more than 90 days past due. The consequences are severe. With average credit card APRs hovering around 22.4%, consumers now pay nearly $280 billion annually in interest, money siphoned out of the economy. While official inflation sits at 2.8%, real costs tell a different story. Electricity is up 9% year over year, auto insurance 16%, and property taxes in metros like Clark County, Nevada, and Travis County, Texas, have jumped 18% to 27% since 2020. Wages, by contrast, have grown just 3.1%. This imbalance explains why the financial system appears stable on paper, even as millions quietly fall behind. Housing affordability data reveals how deep the strain has become. The median home price reached $423,100 in August 2025. At a 6.35% mortgage rate with 10% down, the typical monthly payment is now $2,340, requiring an annual income of about $94,000 to qualify. Yet the national median household income is only $78,800, creating a $15,000 structural affordability gap. This disconnect has driven first-time buyer participation down to just 24%, the lowest since records began in 1981. Among younger Americans, 67% say they cannot afford even a down payment, and 49% say they couldn't sustain monthly costs even if approved. The debt ratio has now surpassed normal recession thresholds. The average household allocates 45 cents of every dollar to debt service, mortgage, auto, and credit combined. As interest costs rise, cash flow collapses. Once emergency savings vanish, delinquencies multiply. Mortgage servicers in Nevada, Florida, and California report non-payment growth exceeding 31% year-to-date, mirroring early indicators of the 2008 housing collapse. This pattern is mathematically predictable. Stagnant wages plus rising costs equal unavoidable defaults. The system cannot rebalance through refinancing because high-rate mortgages have locked borrowers into obligations they can no longer escape. Every data set, debt ratios, affordability indexes, and delinquency charts confirms this is no longer a temporary strain, but a structural failure in consumer finance. The consequences are already visible in market liquidity. Home listings have risen 19% nationally, while transaction volume has dropped 14%, signaling that buyers are disappearing faster than sellers can adjust prices. The pressure from rising delinquencies and tightening credit has entered a feedback loop where the housing market is effectively consuming itself. The more banks restrict lending, the faster defaults compound. By September 2025, the U.S. recorded 196,742 new foreclosure filings, an 8.1% increase from the prior quarter. The unpaid principal on those properties now exceeds $62 billion, enough to wipe out the quarterly profits of the 10 largest regional banks combined. Every percentage point rise in foreclosure filings removes roughly $7 billion in collateral from circulation, choking local liquidity and further suppressing sales activity. Inventory data highlights the scope of this shift. Active listings nationwide have climbed to 1.32 million, compared with 1.8 million a year earlier, yet pending sales have fallen 15%. Rising supply no longer means rising demand. The share of homes with price reductions now stands at 38.4%, the highest since 2012. In once red-hot metros like Las Vegas, Tampa, Phoenix, and Charlotte, median prices have dropped between $27,000 and $41,000 since January. Nationally, average homeowner equity has declined by $18,700 in just 6 months, erasing $1.9 trillion from total household net worth. Mortgage servicers are quietly absorbing the fallout through surging non-performing loan reserves. Collectively, the top 5 U.S. banks have boosted their non-performing loan (NPL) provisions by $10.6 billion since Q1, signaling a clear internal acknowledgement that payment defaults are no longer temporary disruptions. Loss recovery ratios have sharply deteriorated, from 87% in 2022 to just 74% in 2025, as declining home values prevent lenders from recovering balances through resale. In essence, the financial system is recycling bad debt at a discount, with every transaction writing down capital that cannot be replenished through new borrowing. This environment is already transforming buyer behavior across the U.S. housing market. Cash transactions now account for 33% of all home purchases, up from 23% 2 years ago, proving that only liquidity-rich buyers can still compete. Individual purchasers dependent on mortgage credit have fallen 27% year over year, leaving a widening gap rapidly filled by corporate investors, REITs, and private equity funds. This migration of ownership is not incidental, it's structural. As traditional households lose access to affordable credit, institutional buyers are consolidating control of entire neighborhoods at below-market valuations. What began as localized distress among over-leveraged homeowners has evolved into a nationwide deleveraging cycle. Each phase, rising foreclosures, declining equity, and contracting credit, feeds the next with mechanical precision. The financial system has shifted from correction to liquidation, where property ownership is no longer a lifestyle choice, but a capital event. As the foreclosure wave expands, America's housing landscape is being redrawn by capital that never sleeps. Institutional investors, private equity firms, asset managers, and corporate landlords are acquiring distressed real estate at record speed. During the first 9 months of 2025, an estimated 412,000 single-family homes changed hands through bulk transactions totaling $92.4 billion. Nearly 61% of these acquisitions were completed entirely in cash, bypassing traditional financing. Properties once valued at $340,000 are now being purchased for 60 to 70 cents on the dollar, creating instant arbitrage profits while erasing decades of homeowner equity. The strategy is efficient, but devastating for regular buyers. As delinquencies convert into REO real estate-owned inventory, institutions buy in volume before listings reach public markets. In parts of Texas, Georgia, and Florida, 1 in every 5 home sales now involves an institutional buyer. Their capital originates from securitized debt pools and yield-hungry investment funds managing over $1.3 trillion in total assets. For these entities, falling prices are not a threat. They're an entry point for permanent ownership. Every $1 billion invested in this cycle secures roughly 3,800 housing units, meaning the 10 largest funds could control more than 300,000 properties within 2 years. This concentration of ownership is fundamentally reshaping market dynamics. While inventory appears abundant on paper, actual supply available to families continues to shrink as homes convert into rental stock. Rental conversions surge, homeownership rates fall. In 2020, households owned 65.4% of occupied homes. By mid-2025, that figure has dropped below 62%, the steepest decline in 50 years. Median rent for converted foreclosure homes now averages $2,160, up 14% from last year. The cycle forms a closed loop. The same capital driving foreclosures through debt exposure later profits by leasing those homes back to displaced owners. This shift exposes a structural imbalance that no interest rate cuts or stimulus programs can reverse. The U.S. mortgage market has split into two realities: one where households borrow and struggle to survive, and another where institutions purchase and hold at scale. As liquidity concentrates at the top, local economies lose ownership diversity, property tax bases destabilize, and affordability collapses further. This is not a market correction. It is an industrial-scale asset transfer. Comparisons to 2008 miss the essence of the current crisis. That collapse stemmed from bad lending. This one is driven by systemic imbalance. In 2008, homeowners owed more than their homes were worth. In 2025, they still hold equity, but it's evaporating faster than liquidity can preserve it. Total homeowner equity peaked at $33 trillion in late 2024. By mid-2025, total homeowner equity has fallen to $31.2 trillion, a contraction of $1.8 trillion in less than 9 months. At the same time, the number of underwater mortgages has surged 58%, climbing from 1.3 million to 2.1 million properties. The credit environment has fundamentally changed. Adjustable-rate subprime loans, the catalyst of 2008, now account for less than 3% of all mortgages. Yet today's risk isn't credit quality, it's systemic exposure. Mortgage portfolios are heavily concentrated in institutional hands, meaning a localized shock now multiplies instantly through securitized instruments. Every 1% decline in national home values vaporizes roughly $280 billion in collateralized assets, directly hitting pension funds, insurance companies, and global holders of mortgage-backed securities. Monetary policy offers little protection. The Federal Reserve's September rate cut from 4.25% to 4.0% barely moved mortgage rates, which remain anchored near 6.3%. Rate reductions no longer translate into affordability because liquidity is trapped inside high-yield bonds and institutional real estate holdings. Meanwhile, inflation persists above 2.7%, ensuring that real income growth remains negative. This mix, high debt, stagnant wages, and restricted liquidity, creates a slow-motion contraction rather than a visible crash. Unlike 2008, this downturn carries deep social and political consequences. As homeownership declines, wealth concentration intensifies. The top 10% of property owners now control 44% of all residential real estate value, up from 34% a decade ago. Housing is shifting from basic necessity to financial inventory, distorting rental pricing, neighborhood demographics, and mobility. The real danger lies in the illusion of control. Institutions can absorb losses, individuals cannot. That asymmetry prevents natural correction. Instead of a sharp collapse followed by recovery, the system drifts into stagnation. Prices soft enough to erode equity, yet high enough to block new buyers. By late 2025, the surface appears deceptively stable. Home values fluctuate within narrow bands. Unemployment remains under 5%, and headline inflation shows moderation. Yet beneath these numbers, liquidity, credit, and confidence are collapsing together. Pending foreclosures awaiting court approval now exceed 540,000 properties, representing more than $126 billion in distressed debt poised to hit the market in early 2026. Banks are delaying repossessions to avoid triggering valuation write-downs that would destabilize quarterly results. This manufactured calm is dangerous. It hides acceleration. Rental vacancies are rising, yet rents remain elevated. Housing supply is expanding, yet affordability keeps shrinking. It's the mathematics of systemic distortion. A market operating at half its normal transactional velocity cannot self-correct. Current absorption rates show only 67% of listed homes sell within 90 days, compared to 91% 2 years ago. A 24-point decline representing 460,000 unsold properties. Inventory accumulating like pressure beneath tectonic plates. Monetary buffers are nearly exhausted. Federal and state homeowner aid programs have consumed over $48 billion since 2022, while delinquency relief funds are down to just $3.2 billion nationwide. Meanwhile, consumer savings have fallen to $740 billion, the lowest since 2013, even as revolving credit hits record highs. These conditions guarantee that any additional shock, a job contraction, insurance crisis, or credit freeze, will push the system beyond equilibrium. What's coming will not resemble a traditional crash. It will unfold as a slow, uneven economic landslide. Property values might decline only 10 to 15%, but the resulting wealth effect could erase $4 trillion in household equity, crushing demand for years. Institutional buyers will survive. Middle-class homeowners will not. The illusion of a soft landing will vanish the moment delayed foreclosures flood the market. The silence of stability is the loudest warning. Every metric, delinquency, equity loss, transaction decay, points in